Yesterday, we told you a U.S. naval armada was heading to Iran. We showed you the intelligence. We showed you the strike window. We told you January 31st to February 1st. And today, President Trump confirmed it. He posted on Truth Social, a massive armada is headed to Iran. It is moving quickly with great power, enthusiasm, and purpose. We were right again. But while you were watching the warships cross the Persian Gulf, something far more destructive happened. President Trump just gave the order to kill the dollar. And he did it on camera in front of reporters with a smile on his face. If you are seeing this before the markets close today, you are part of the resistance. You're one of the few people who understand what just happened to the global monetary system. Hit that subscribe button right now. We are the only channel tracking the death of the dollar in real time. Turn on notifications because what I'm about to show you is the moment the United States abdicated its role as the world's reserve currency. Do it now. Let me give you the timeline because what happened in the last 48 hours will be studied in economics textbooks for the next 100 years as the inflection point where dollar hegemony collapsed. Tuesday, January 27th, 12:45 p.m. Eastern Time, Urbandale, Iowa. President Trump is standing in front of local business owners doing a press gaggle. A reporter asks him directly, "Mr. President, has the dollar fallen too much?" And Trump responds, and I want you to hear his exact words, "No, I think it's great. I mean, the value of the dollar. Look at the business we're doing. The dollar is doing great." Let me pause there because no sitting U.S. president since Richard Nixon closed the gold window in 1971 has openly celebrated currency debasement during a crisis. Not Reagan, not Clinton, not Bush, not Obama, not Biden, none of them. They all defended the strong dollar policy because they understood one fundamental truth. The moment the President of the United States says he wants a weak dollar, the entire global monetary system loses its anchor. Trump just cut that anchor. Here's what happened next. 1:15 p.m. Eastern. The dollar index, the DXY, begins accelerating its sell-off from 97.05. 2:30 p.m., DXY crashes through the 96 psychological support level, 3:45 p.m. session low of 95.566. That is the lowest level since February 2022. The close 96.16, down 1.3% in a single session. That is the worst one-day rout since April 2025. Currency strategists interpreted Trump's remarks as explicit verbal intervention, a green light for dollar liquidation. Eugene Epstein, head of structured products at Moneycorp, said this: "Over the last few trading sessions, both the U.S. Treasury Secretary and the President have seemingly given traders the green light to sell the dollar. They were already offloading it, and their comments just fueled the fire." So let me explain the strategy, because this is not incompetence, this is deliberate policy. The administration's calculus is straightforward. A weaker dollar erodes the real value of $36 trillion in federal debt. It improves trade competitiveness for exporters, which represents 11% of GDP, and it inflates nominal GDP figures for political messaging. The costs, imported inflation, erosion of reserve currency status, capital flight, those are either discounted or considered acceptable collateral damage. Trump is crashing the dollar to pay off the debt, and your savings, your purchasing power, your retirement account denominated in dollars, that is the collateral damage. And the man who called this entire mechanism, Robin Brooks, senior fellow at the Brookings Institution, former chief economist at the Institute of International Finance, he issued a stark assessment Wednesday morning. He said, "La dollar weakness is supercharging the rise in gold, adding fuel to the fire for the crazy rise in precious metals." Brooks identified the causal mechanism as the DXY declined from 99 plus in mid-January to sub-96 by January 27th. That's a 3% drop in 2 weeks. Gold priced in dollars became mechanically cheaper for non-dollar holders. Chinese buyers, Middle Eastern sovereign wealth funds, European pension funds, they all faced arbitrage opportunities. They drained physical inventories from London and Zurich vaults and redirected flows to Shanghai and Hong Kong. This is not speculation, this is mathematical arbitrage. When the dollar loses 3% of its value in 2 weeks and you're sitting on $1 trillion in reserves denominated in US Treasuries, what do? You diversify. You buy gold, you buy silver, you buy anything that is not a claim on the full faith and credit of a government that just told you it wants its currency to be worth less. And the market reaction? Violent. gold spiked to 5,591 aught. That is a $150 vertical move in just 48 hours at approximately 3:49 GMT, which is 10:49 p.m. Eastern Wednesday, 11:49 a.m. Thursday in Asian markets. By mid-AM morning, European trade, it settled around 5,538, but that peak 5,591, that's up $150 in 48 hours since the Fed meeting. That's up 25% plus year to date from January 1st to 29th. That's up 64% in 2025, the largest annual gain since 1979. Silver mirrored gold's parabolic ascent. It hit 119.34 within a whisper of 120 before easing to 11.30. Year-to-date gains exceed 60%, driven by industrial demand shortages for solar and EVs, investment demand, and momentum algorithms that are now chasing this thing into the stratosphere. Let me show you the table. Gold January 29th high, 5591. Year-to-date gain 29.3%. 2025 gain 64%. Silver January 29th high, 119.34. Year-to-date gain 63.5%. 2025 gain 100%. Platinum hit 29.18 on Monday, up 24.5% year-to-date. And here's where it gets terrifying. Nikki Shields, head of metal strategy at MKS PAMP, one of the world's largest precious metals refiners, issued a stark characterization Wednesday. She said, "I would classify the precious metals markets as broken due to unprecedented volatility." Let me repeat that. The head of metal strategy at a major physical dealer, a firm that trades physical gold, silver, and platinum globally, just called the markets broken. She described price action as unheard of, driven not by orderly supply-demand dynamics, but by erratic liquidity flows and momentum buying, detached from fundamentals. When the person whose job is to clear physical metal transactions tells you the market is broken, that signals structural dislocation, bid-ask spreads widening, counterparty risk rising, price discovery failing. And while the futures markets are setting record prices, the physical markets, they're in panic mode. Let me take you to Shanghai, Tuesday, January 27th. Gold seller Xiao Jinhao at a Shanghai jewelry mall. There are still quite a lot of people buying it because gold awareness is a long-term trend and it's still heading upwards. 68-year-old resident Wang Kuqin. If this keeps up, gold is still likely to go higher. I can still mentally accept the current price level, so I decided to come buy some. Hong Kong Tuesday through Wednesday, Simon Littman, executive manager of Swiss Investors Corporation Limited. January this year was best ever in around 20 years in the trade, but we have supply problems. Small gold bars are delayed due to strong demand. Refineries are rushing to boost production. At Choney Gold Shop in the Central Business District, dozens of people queued outside. Some had to wait hours to enter the premises where they had trinkets like bracelets, necklaces, small statuettes, and bars put onto scales to be weighed. This is a bank run. This is what happens when the President of the United States tells the world he wants his currency to be worth less. People rush to convert paper into metal. And the Hong Kong Airport Authority, they're planning to expand gold storage capacity to over 2,000 metric tons within 3 years, formalizing Hong Kong's role as Asia's gold reserve hub through a memorandum of understanding with the Shanghai Gold Exchange. Do you trust the paper money in your pocket or the metal in the vault? If you understand that physical assets cannot be printed, cannot be debased, cannot be frozen by executive order, hit that like button right now, because what's happening in Shanghai and Hong Kong is coming to New York and London. It's just a matter of time. Now, let me take you inside the Fed meeting, because what happened Wednesday is the moment the Federal Reserve lost control of monetary policy. Wednesday, January 28th, 2 p.m. Eastern. The Federal Open Market Committee voted 10-2 to hold the federal funds rate at 3.5 to 3.75%. But those two dissents, they reveal a fracturing consensus. The dissenters voting for a 25 basis point cut. Governor Christopher Waller, a Trump appointee during his first term, who is reportedly on the short list to replace Powell, and Governor Stephen Moran, currently on leave from his role as chairman of Trump's Council of Economic Advisors. Moran has dissented in favor of larger cuts at the 3 previous meetings, initially advocating for a 50 basis point reduction. His presence on the board represents the most explicit political infiltration of the Fed in modern history. When the chairman of the President's Council of Economic Advisors is sitting on the Federal Reserve Board voting to cut rates while inflation is running at 3%, that is not monetary policy independence. That is political capture. And then Powell held his press conference 2:30 p.m. Eastern. And what he said will go down as one of the most delusional statements in central banking history. When asked about gold's historic surge, the metal had breached 5,300 during the meeting and was climbing toward 5,400 as he spoke. Powell dismissed concerns with rehearsed nonchalance. He said, and I quote, "We do not derive significant macroeconomic insights from this. One could argue that we are losing credibility, but that is simply not accurate. If you examine inflation expectations, our credibility is precisely where it should be." Let me deconstruct that statement. Number one, gold as non-information. Powell claimed that gold at 5,300, up 64% in 2025 and 25% year-to-date, conveys no significant macroeconomic insights. This defies the asset's 5,000-year history as the ultimate hedge against fiat currency debasement and sovereign credit risk. Number two, inflation expectations as the sole metric. Powell anchored credibility exclusively to inflation break-evens and survey data, ignoring that these lagging indicators failed to predict the 2021 to 2022 inflation surge. Gold, by contrast, is a real-time market clearing price reflecting aggregate global capital flows. Number three, the $150 contradiction. During Powell's 45-minute press conference from 2:30 to 3:15 p.m. Eastern, gold surged from approximately 5,300 to 5,450, a $150 gain. While he denied credibility concerns, this is the market's verdict. The market voted. Powell lost. Powell characterized the decision as data-dependent prudence. He said, "Following the recent 3 rate cuts, we are well prepared to tackle the risks associated with our dual mandate. But the reality is institutional paralysis. The Fed faces political pressure. Trump's DOJ has opened a criminal investigation into Powell. The White House is attempting to fire Governor Lisa Cook. Trump has threatened Powell's removal on day one. The Fed faces inflation persistence. Core PCE inflation stood at 3% in December, still 50% above target with tariff-driven goods inflation accelerating, and the Fed faces a dollar crisis. The DXY's 10.94% decline over 12 months represents the worst performance since 2003. Yet Powell refused to comment on currency markets, stating, "We do not engage in discussions about the dollar. The Fed has lost control." With Waller and Moran dissenting for easier policy while inflation runs at 3%, the FOMC has lost the capacity for counter-cyclical policy, and gold's $150 surge during the press conference was the loudest signal. Capital is fleeing the dollar treasury complex faster than the Fed can stabilize it. And then there's the geopolitical accelerant, because while Powell was denying reality, Trump was announcing war. Wednesday, January 28th, 6 a.m. Eastern, Trump posted on Truth Social, "A massive armada is headed to Iran. It is moving quickly with great power, enthusiasm, and purpose. Hopefully, Iran will quickly come to the table and negotiate a fair and equitable deal. No nuclear weapons, one that is good for all parties." The statement confirmed the deployment of the USS Abraham Lincoln Carrier Strike Group, multiple guided missile destroyers, bombers, and fighter jets to the Persian Gulf. Trump explicitly compared the buildup to the armada he assembled near Venezuela before the January 2026 operation that captured Nicolas Maduro. This is not posturing. This is operational deployment. Trump justified potential military action by citing Iran's brutal crackdown on protests that erupted December 28, 2025, following the real's collapse. U.S.-based human rights activist news agency reported 6,221 killed as of January 28, including 5,158 protesters. Other estimates placed the death toll between 6,000 and 30,000, with over 42,300 arrested. Iran cut internet access 3 weeks ago, rendering verification impossible. And Iran's response, their UN mission, responded with a direct warning mirroring Trump's social media style. Iran stands ready for dialogue based on mutual respect and interest, but if pushed, it will defend itself and respond like never before. The delegation cited the U.S. experience in Afghanistan and Iraq. $7 trillion squandered, 7,000 plus American lives lost. Deputy UN Ambassador Golem Hossein Darzi added, "Any act of aggression, direct or indirect, will be answered firmly, proportionately, and lawfully. This is not a threat, but a statement of legal reality. Markets priced in supply disruption risk immediately by Thursday morning. Brent crude 69.39 per barrel, up 1.5%, highest since September 2025. WTI crude 6427, up 1.7%. Three-day gain, both benchmarks up nearly 5% since January 26th. Citi Research estimated the geopolitical risk premium at $3 to $4 per barrel, with potential upside to $72 per barrel if conflict escalates. Iran produces 3.22 million barrels per day, 4% of global supply, and controls the Strait of Hormuz, through which 21% of global oil passes. If that strait closes, oil doesn't go to 72. Oil goes to 100, 120, 150. And that oil spike, it feeds directly into inflation, which feeds into gold, which feeds into dollar collapse. This is the inflationary synthesis. War drives oil and commodities higher through supply shock. Weak dollar amplifies imported inflation through mechanical pass-through. The Fed remains paralyzed due to political constraints preventing tightening. Capital flees to gold and silver as a debasement hedge. This is the 1970s playbook. Geopolitical chaos plus currency crisis plus policy impotence equals double-digit inflation and precious metals mania. And we're watching it unfold in real time. Now let me show you what Wall Street is saying, because the major banks are scrambling to revise their targets upward. Goldman Sachs previous target 4,900, current target 5,400, upside case skewed upside. They revised January 22nd. Deutsche Bank, no previous target, current target $6,000, upside case 6,900. They revised January 27th, so general current target 6,000, which they're calling conservative revised. January 26th, Morgan Stanley, previous target 4,600, current target still 4,600, but bull case 5,700. Bank of America, previous target 4,438, current target 5,000. Goldman Sachs justified its 10% upward revision by noting that private sector diversification buyers whose purchases hedge global policy risks don't liquidate their gold holdings in 2026. They expect Western ETF inflows of 500 plus tons versus their previous forecast based solely on Fed cuts. Central bank purchases averaging 60 tons per month in 2026 and 50 basis points of additional Fed easing, 2 cuts. Deutsche Bank's $6,000 base case, 6,900 upside, reflects persistent investment demand as central banks and investors increase allocations to non-dollar and real assets. The explicit reference to non-dollar assets acknowledges the dollarization thesis. BRICS nations reducing dollar reserves from 58.2% in 2024 to 56.92% in early 2026, accelerated by the 2022 freezing of Russian assets. And speaking of the Fed, there's one more piece of chaos. President Trump is expected to announce his nominee for Fed chair as soon as this week, with a selection replacing Jerome Powell when his term ends in May 2026. Prediction markets have undergone a violent rotation. Polymarket odds as of January 27th. Rick Rear from BlackRock CK, 47% up from 3% on January 12th. Kevin Wersch, former Fed governor, 28%. Kevin Hassett, CEA chairman, lower odds because Trump wants him to stay at CEA. Christopher Waller, Fed governor, under consideration. Rick Rear is the chief investment officer of global fixed income at BlackRock CK, overseeing a $2.5 trillion bond portfolio. He's dovish on rates. He argued in December that rates remain excessively high for the housing market and called the Fed funds rate an overly blunt tool. He believes the neutral rate is around 3%, slightly below current levels but higher than Trump desires. He supports using the Fed's balance sheet to influence the economy, aligning with Trump's preference for unconventional tools. And BlackRock CK managed the Fed's corporate bond purchases during the COVID crisis, establishing operational ties. Following an interview with Reader, Trump told CNBC the BlackRock CK executive was very impressive. This comment combined with Trump's statement that we're down to 3, but really just 2, and I can probably tell you in my mind we might be down to 1, suggests Reader has gained momentum. Krishna Nagwa, head of global policy and central bank strategy at Evercore ISI, observed that Reader, as BlackRock CK's fixed income CIO, brings a perspective rooted in detailed corporate data analysis rather than abstract economic theories, and that the market would likely embrace Reader as a representative of its interests. So let me be very clear about what this means. If Trump appoints Reader or Waller or anyone on his shortlist, The Federal Reserve will become explicitly subordinated to presidential preference. The institution that is supposed to be the firewall between political expediency and monetary stability will become an extension of the White House. And when that happens, the last remaining reason to hold dollars, the belief that the Fed will defend price stability independent of political pressure, that reason evaporates. The past 48 hours represent an inflection point in the slow-motion collapse of dollar hegemony that began with a 2022 freezing of Russian reserves. BRICS reserve shift dollar holdings declined from 58.2% in 2024 to 56.92% in early 2026. BRICS unit launched December 2025 launch of a gold-backed settlement system, 40% gold, 60% BRICS currencies. Central bank buying 60 tons per month average in 2026, continuing a multi-year trend. Shanghai Hong Kong Hub Memorandum of Understanding formalizing Asia's alternative gold clearing and storage infrastructure. The difference today is that the U.S. president is accelerating, not resisting this trend. By celebrating dollar weakness, Trump removed the psychological barrier, preventing sovereign wealth funds, central banks, and pension funds from openly diversifying away from dollars. Trump's weak dollar policy serves short-term political goals. Nominal GDP inflation boosts tax revenues. Real debt burden declines, inflating away $36 trillion. Export competitiveness improves marginally, but the long-term costs are catastrophic. Imported inflation. The U.S. imports $3.2 trillion annually. Higher borrowing costs as Treasury yields rise when foreign demand wanes. Capital flight as investors demand an inflation risk premium. Stagflation risk as growth slows while inflation accelerates. The Fed, paralyzed by political pressure and institutional erosion, cannot arrest this dynamic. With Waller and Moran dissenting for easier policy while inflation runs at 3%, the FOMC has lost the capacity for counter-cyclical policy. Nikki Shields' characterization of broken markets reflects three structural fractures. Number one, price discovery failure. When gold moves $150 in 48 hours on no fundamental news, prices no longer reflect supply-demand equilibrium. They reflect panic positioning. Number two, physical paper disconnect. Shanghai and Hong Kong supply shortages, while futures markets set records, suggest the paper derivative market is detaching from physical reality. Number three, liquidity collapse risk. If refiners cannot meet delivery obligations, or if major holders like the GLD ETF face redemption waves exceeding available inventory, the system faces a banker-run scenario. The closest historical parallel is 1979 to 1980, when gold surged from $226 in January 79 to $850 in January 80, a 276% gain in 12 months as inflation hit 14.8% and dollar confidence collapsed. That crisis ended only when Paul Volcker raised rates to 20%, triggering a severe recession. Today, the Fed lacks the political capital for a Volcker-style shock. Powell's term ends in May. His likely successor, Reeder or Waller, will face a choice: defend the dollar and trigger recession, or accommodate inflation and watch gold reach Deutsche Bank's $6,900 upside case. The sequence from Tuesday's Iowa press gaggle to Thursday morning's $5,591 gold print represents the moment the U.S. dollar's exorbitant privilege began its terminal phase. Three converging forces have created a self-reinforcing debasement spiral. Number one, presidential endorsement. Trump's "I think it's great" removed the taboo against dollar decline, giving institutional investors permission to reduce dollar exposure. Number two, Fed paralysis, a 10-2 vote with dovish dissents. Powell's credibility delusion and imminent leadership change signal the Fed has lost both independence and control. Number three, geopolitical acceleration. The Iran armada threatens oil supply. Disruption, adding stagflationary fuel to an already combustible mix, is voting with unprecedented clarity. Gold up $150 in 48 hours. Silver at 119, oil at 4-month highs, DXY at 4-year lows. The market sees what Powell denies. The dollar treasury complex is losing its gravitational pull. If Deutsche Bank's $6,000 base case, 6,900 upside, materializes by year-end, it implies gold gains another 8 to 24% from current levels. More importantly, it implies the dollar loses another 8 to 24% of its purchasing power, not against goods, but against the 5,000-year store of value that no central bank can print. The system broke today. The president wants the dollar down. He said it out loud. The Fed is paralyzed by political capture and institutional erosion. The war drums are beating. The armada is moving toward Iran. The strike window opens Friday. Oil is spiking. Inflation is accelerating. And gold. Gold is telling you the truth that your government won't. Are you ready for $6,000 gold? Tell me your prediction in the comments below. 6,000 by March, 6,500 by June, 7,000 by December. What's your target? Drop it in the comments. The weak hand sold at 103 on Monday. The strong hands held through Tuesday. The smart money bought the dip. And now on Thursday, they're watching the dollar die in real time. The question is, are you positioned for what comes next? Subscribe to this channel. Turn on notifications because when gold breaks 6,000, when silver breaks 125, when the DXY breaks 95, when the missiles fly toward Iran, when Powell's replacement gets announced, when the next crisis hits, we will be here breaking it down in real time. Don't be the last to know. Stay sharp. I'll see you in the comments.